Right, so our first company to present this morning is Nedbank. Nedbank have been included in the SRI index since 2004. They've been listed on the JSE since 1969, and they're also listed on the Namibian Stock Exchange. They're listed in our financial sector, are a constituent of our top 40 index. Their shares trading at 240 Rand, and they have a market cap of just under 119 billion Rand. And their share price since 2000, so we've just chosen, because different companies have listed at different years, so we've chosen a base year of 2000 to give you a comparative. Their share price has increased by 77% since 2000. So without further ado, I'd like to call up Alfred Visagie, who is the head of sustainability for Nedbank. Thank you, Alfred.
Ladies and gentlemen, and Carla, thank you very much for the opportunity to invite us and for us to share some of our insights on our journey on ESG. We're a very passionate company. Some of these, people always ask, how do you do this? It's in our DNA. It's in our scorecards. It's in the conversations that we have, and I'm proud to share some of that with you today. I'm head of investor relations, so just to give some context, I'm not an ESG expert, but we do 350 investor meetings a year in South Africa and abroad. And I think we're very proud. We started around 2 years ago with what we call a governance roadshow, where we take our chairman and our lead independent director to go and see our shareholders as well. And in that environment, we also then engage on a lot of ESG matters. We leave all the financial performance and the competitive stuff for our executive, and that really opens the door for really good conversations, remuneration, environmental, social issues. I wanted to talk a little bit about Nedbank and where we position, but Carla's done a great job, so I'm not going to repeat that, except to say that, just add to that, we're the fourth largest bank in South Africa, above 860 billion in assets. What makes us a little bit different from our peers, we're more of a wholesale than a retail bank, about 60-40. So it does give us different dynamics in this type of environment. Just some context on what I'm going to share with you today is I'm just going to quickly touch on the context in which we operate, and we take material matters quite seriously. We've got 6 of those. I'm just going to give you some context on that, and then I'm going to use the value driver model to take you through how we think about growth, productivity, risk management that leads to higher cost of equity. Okay. We've got 6 material matters that's very important for us as a bank. This is all developed internally through our business planning processes, discussed, debated, vetted by the board eventually, and you guys can read this in our integrated report. But essentially, as a bank, we are integral to what happens in the economy. Firstly, we see exactly what's happening to our clients, to the consumer, the small businesses, what's happening during load shedding, what's happening to our big corporates, and how are they impacted by the environment. And in the last few weeks, we had a lot of noise around what's happening in the mining sector. And we stay close to that because as a bank, you are leveraged and you have to look after your interests to your shareholders, but also to your clients. So the current environment is really a big issue for us, the tough economic environment. The second one that we focus on is what we call banking relevance and consumerism. It's very much around the competition that's out there, not just only from the big other banks, but also some of the newer players, some of the new technologies and products that are coming in and disintermediating banks. And if you don't stay at the forefront of those, and if you're not close to your client, there's a real risk that you will be disintermediated going into the future. So it's very important for us to stay close to our customers. In our latest results presentation, we spoke about what we call a regulatory tsunami. It just feels like every week, every month, there's just more things that you have to comply to, and it just adds more costs. There's obviously a very good reason for this. It's to protect the consumer out there. It's to make sure that banking systems, and it started off internationally, remain sound and sustainable. And therefore, a lot of these things that get introduced has got a good outcome, although it is painful sometimes for us as a bank and for some of our clients. When somebody comes and asks you, please, you need to FICA yourself again because there's a new requirement, it's not great as a banking client to go back to your branch and do it. But there are reasons for that will make banking and the world a safer place. Not all is negative. We do think there is great growth opportunities in the rest of Africa, especially with the higher GDP growth that we see north of our borders. We do think that there's still going to be a lot of volatility. These material matters have been on the agenda for the last 4 years, but we've had a lot of volatility. Just think about the oil price and what that has done to the economies of Nigeria and the uncertainty. As the green bank and as socially responsible bank, we take what's happening in the world and in society very seriously. And we keep on thinking about issues such as climate change, water scarcity that's coming, and how do we play our role in that? How do we ensure energy security? How do we make sure that we play our part in things like healthcare, in education? And I'll touch a little bit on that a little bit later when I talk about Fair Share 2030, which is an initiative that we've launched recently. And then just lastly, I think we all struggle with that, scarce skills. In a country that doesn't necessarily produce the right level of skills, what is it that we as corporations do, and especially banks, because it's a highly skilled environment, how do you make sure that you develop, nurture, retain your people, and then also plow back into society so that you can get a better outcome. So that's the context in which we operate. I'm going to talk to you through growth, the productivity and risk management, and the heading at the top comes from our interim results, so this is not specifically developed for this forum, but it talks to the growth opportunity. How do we deliver growth and value in a tough macroeconomic environment? So I think firstly, we need to look at Nedbank's history. Those of you who have known Nedbank for a long time, Nedbank 10, 15 years ago was, there were all those fancy ads out there. Who are those people? And, it's the bank of the 2000s and the Nedbank of today is a very different bank. We had to do a lot of investment to make sure we remain competitive and relevant in the society that we operate. As such, we had to make sure we've got a proper presence in South Africa. We were in some of the big metropolitan nodes, but we weren't necessarily relevant to all South Africans. So what we did is we invested quite significantly in our staffed outlets. It's up 33% since 2010 and actually up more than 40% since 2009. Now, a lot of people would say, well, why are you investing in branches when the world's going digital? In South Africa, the branch is still a very important channel. It serves as a sales and distribution channel, but also as educating clients. And we had to make sure that we are in all the right regions. We think we've now reached that level where we're very competitive to our peer group. We are in most of the areas. We're a lot more visible, and that's also seen in the ATM space. In ATMs, that's increased by 64% and over 100% since 2008. So there's no more excuses to say, I can't find a Nedbank branch or an ATM. We're still going to invest a little bit more in ATMs, but the branches, what we're doing now is we're focusing more on the client experience, and we've actually rolled out what we call our branch of the future, and these are tech-savvy branches. We've got things like video banking, so if a client comes in and they've got a specific need that's not covered by somebody in the branch, you can link up to a video banker and they can help you there and then. So, we're sort of thinking about how do we optimize that experience. A lot of technology that we've enabled in the branches. Some of our branches, you can take a ticket, go do your shopping, and come back a little bit later. The benefit of Branch of the Future is also reduced floor space, so it saves us cost. we need less people to operate in there, and sales have actually increased. So for Nedbank, our biggest opportunity is still in South Africa, where we've got a lower market share in the retail space. And I think through some of these initiatives, we are definitely, it's definitely giving us a growth channel. But we're not just thinking physical infrastructure. We're also investing quite a lot in the digital space. We wanted to make sure that as we enter the digital space for our clients, that it's on the most secure platform. We're the first bank to introduce what's called Approve It. And I can say that with the onslaught of fraud and hacking and phishing sites, we've had almost 0% fraud on our internet banking since we've introduced Approve It. We wanted to make sure. Now, that's not something that clients always see, the security, but when things go wrong, they always want to say, well, why did this happen? So we've got a very secure banking platform. At the bottom, the branch of the future, we've rolled out 171. Our app suite, which is app is the in thing these days, won the MTN Consumer App Award in 2013. Not the banking app, the best consumer app. And we're quite proud of that. And you can see the trends across all these lines, digital clients all increasing. We're focusing a lot in innovation. And I think Nedbank's also first with a lot of things, especially in this environment where we've got load shedding. Our Approve It app, our Pocket POS device, it's a device which was originally developed for the one-man type businesses, a plumber that would go out to a house. How do you get a payment done? You stick in your card in a device, like a point-of-sale device. And what we've actually now found is a lot of companies are actually using it because it's battery-powered. So when the power goes off, you don't need all the point-of-sale devices. And then I'll talk a little bit about the instant bond indicator just a little bit later. But those are all successes that we've had. So it's playing in the physical space, but a lot in the digital, a lot of investment there. Now, what has that done? That's resulted in very, very strong client growth for Nedbank. We've had our total clients up over 5 years from 5.1 to 7.1 million. And more importantly for us is what we call our main bank clients, people that do their day-to-day banking with us, up from just over 2 million to 2.5 million. Now, in there still lies the big opportunity for Nedbank. Our market share of transactional clients in South Africa is still only 11%. Our natural market share is around 19, 20%. We still want to get our transactional banking market share up to that. Since 2000, we've launched a lot of new products. Nedbank was never a big player in kids and youth. We introduced branches on all the campuses. We created products that are more relevant to clients. Our success story has been entry level. We've got a product there called Kiona, which is exactly the same price as a Capitec account, 5 Rand. People always tend to focus on bank fees, but we differentiate to make sure that we've got the right product for the right client. For 5 Rand, you can get a Kiona account. The middle market, that's where everybody fights for market share. And that's a tough space. That's where we compete against the FNBs and the Standard Banks and the Absas of the world. And I must say, we've also been growing very strongly in there. But I think very importantly is if you don't build the relationships with the youth and the children and the entry level, you won't have a feeder into the middle market down the line. And I think that's one of the lessons the hard lessons that Nedbank learned over the years. And we're now seeing the benefits of growing our entry-level clients and growing our youth clients 3-4 years ago. As those people migrate, as they started getting jobs and become more wealthier, they become your middle market clients of the future. And Nedbank's always been very strong in the professional and the small business and business banking space, and we'll continue to focus on that. So still a lot of growth opportunity for us in that space. If we look a little bit beyond our borders, South Africa's a tough space, savvy competitors, very competitive. The growth opportunity is beyond our borders. When we think about our Africa strategy, we think about it in 2 ways. In SADC and East Africa, those are typically countries that are closer to South Africa, countries we know well, generally English-speaking. There's a couple of Lusophone-speaking countries. A lot of our clients are expanding into those. those are countries in which we want to own, manage, and control banks. We've currently got a presence in 6 countries. We want to expand that to 10 countries over time. We're definitely not going to overpay for acquisitions. We're rolling out a standard operating platform across these geographies, which we've just done in Namibia very successfully. We acquired Banco Unico towards the start of last year. Nice startup bank in Mozambique, and has already grown from 0 to 6% market share in a space of 3 years. And then we do a lot of investment banking. So in those geographies, we want to own, control, and manage banks. However, our clients aren't just expanding into SADC and East Africa. A lot of our big corporate clients are going into Central and West Africa. And we chose in 2008 to follow a partnership approach. We started a strategic alliance with EcoBank. Now, EcoBank is, if you look at the latest Banker magazine, the 7th largest bank in South Africa. They've got the biggest geographical footprints. They've got a presence in 36 countries. So together with EcoBank, we can offer our clients access to 39 countries, totally unmatched on the Pan-African, across Africa. They're number 1 bank in 6 countries and number 3 bank in 14 countries. And we had that alliance since 2006. We had the rights to become a 20% shareholder in EcoBank last year, and we took up that right, and we acquired 20%, just over 20% towards the end of last year. We've got working committees every week. How do we work together? How do we make sure we keep our clients happy? If a client, one of our South African clients, bank in Nigeria, how do we make sure that client banks then with EcoBank? A lot of initiatives on the go, and we're very, very excited about this opportunity. EcoBank's also got very good performance metrics, with their ROE continuing to improve over time. Then, just moving on, my last point around fair share, around growth, is what we call Fair Share 2030. It's an initiative we started in 2013, and we said, if we want to thrive as a bank, we can only thrive if South Africa and society, in the broader sense, thrive. So what is it that we can do? What are the levers that we can pull? And how can we assist society to thrive over time? And we've identified 8 focus areas: reducing carbon footprint, create more savings, education, job creation, renewable energy, healthcare, and water. Those are things that we think as a bank, we can't do everything. We can't try to be everything to everybody, but those are areas that we think we've got either ourselves our own skills, or we've got an advocacy position that we can influence, or we can help our clients. And I'll give you a little sense just now. We committed 6 billion rand additional lending. So this is over and above the normal role of a bank, that we're going to do business in a new, innovative way that will make a difference to society. Give you an example. Banks, typically, when you lend into the agriculture industry, you lend for 12 months because that's just the way it's always been done. But if you actually know a little bit about farming, you would know that if you put your fertilizers and everything in, you don't get the returns the first year. So we had a hard look at our credit criteria. How do we structure our products differently to suddenly do it a 2-year type loan with different criteria? And by thinking differently, taking yourself out of the old mindset, we hope that we can make a bigger impact on society. And we've got projects and plans in all of these areas, savings and healthcare, on how we can make a difference by 2030 to South Africa. And it's not just, it's a 3-way thing. It's what's good for our clients, what's good for society, but also it needs to make financial sense. So I'm just going to quickly ask that we just play a little clip on Fair Share. It gives you a good sense of sustainability in general and where Fair Share fits in.
Shift. This is what we know. To help shape the macroeconomy and grow our business sustainably, we need a shift in thinking. A shift not to doing what we can, but to doing what is required to enable an abundant future. Our 8 long-term goals guide this shift, ensuring that we contribute towards good societal outcomes through our core business. We contribute to meeting our goals by focusing on our products and services, our own operations, our investments in CSI, and advocacy or encouraging others to follow suit through bold leadership and partnerships. Our ever-evolving range of products and services focus on growing the economy. And from 2015, through a 6 billion rand lending target per annum, we will intentionally focus on new offerings that deliver positive socio-economic and environmental outcomes addressed by our long-term goals. This is called our Fair Share 2030 strategy. While still in its first year of implementation, by using this strategy to meet unmet client needs, we have already lent into new areas of the healthcare sector, as well as developed products that facilitate energy efficiency and soil protection and care. Other well-known product and services offerings include our Nedbank Green Savings Bond that earmarks invested funds to support Nedbank-funded renewable energy projects, allowing investors to contribute towards South Africa's green future. And our lending to renewable energy investments has made us a key enabler of sustainable energy on the continent. Clients can also support environmental causes by using our Nedbank Green Affinity products, as we donate money to the WWF Nedbank Green Trust on their behalf. Other affinities include the sports, children's, and arts affinities. We also strive to affect socio-economic transformation through empowerment financing, which includes transformational infrastructure projects, affordable housing, agriculture finance, and black SMME financing. Our approach to enterprise development includes direct investment and support through innovations like Pocket POS, which allows card-carrying clients to pay anywhere and anytime using a smartphone. To meet the needs of underserviced communities, we provide offerings such as our Nedbank Kiona Banking Suite and our entrepreneurial and business skills programs targeted at small businesses. And digital innovations such as the Nedbank App Suite have further increased access to our services. 2014 marked 6 years of our being carbon neutral. Our approach is to reduce first and then offset our carbon emissions. And in addition to our suite of green buildings, 6 of which we now occupy, 2015 sees another first for us, as we are now using solar PV to power one of our data centers. We also encourage all stakeholders to maximize their positive impact by encouraging sustainable living and assisting businesses in calculating their greenhouse gas impact. Even our procurement spend is directed to enable shared growth, strong relationships, and greater sustainability across our entire supply chain. And our preferential procurement policies are designed to maximize our contribution to broad-based empowerment. And by creating an inclusive culture that embraces excellence, well-being, and staff volunteerism, we work to retain the truly exceptional people that make Nedbank the business that it is. In 2014, our total CSI spend across the group amounted to 151 million rand. By collaborating with government, civil society, and business, we act to create a better future for South Africa's youth through tertiary support and skills development programs. One such collaboration is with the Ray Mhlaba Skills Training Centre in Port Elizabeth. And our support of the Wildlands Green and Wastepreneur programs aims to uplift the impoverished Acornhoek community in Mpumalanga through innovative job creation opportunities. While our strongest lever for change to promote a sustainable future is to use our core business to innovate and fulfill unmet client needs, we can't do it alone, so we work with others that share this vision. Our investment in the WWF Water Balance Program is crucial for economic growth, as it focuses on the removal of alien invasive trees and releasing water back into the ecosystem. And we are the official sponsor of the WWF SA Sustainable Agriculture Program, which promotes and enables sustainable agriculture as a means of minimizing the adverse impacts of farming on the environment while meeting the growing need for food. We also support and sponsor a range of awards to recognize sustainability leadership across various industries and economic sectors. These include the Nedbank Green Wine Awards and the Nedbank Eston Green Farming Award. All of our external initiatives and internal efforts reinforce our commitment to sustainability by treading more lightly on the environment on which we depend, while using this approach to attract new clients and grow our business sustainably. They define the manner in which Nedbank is contributing towards making a thriving South Africa happen.
Great. Thank you. I had to show that because I don't think I could have said all of that and do it justice. So, but that's that's the way we think. That's the way we run our business. And maybe just to give one last example in the renewable energy space, the green space that Nedbank's been a leader in. Just talking about the three things: we manage and optimize our own impact. We carbon neutral. We take leadership in our own buildings to reduce our own carbon footprint. Then we, through partnership and advocacy, we try to bring others along and advise. And we've got a green carbon guide that's freely available to anybody. And then in the renewable energy space, we've probably been South Africa's biggest funder in the first 4 rounds of renewable energy, which has been very successful. The public-private partnership that's been established. We've committed 35 billion rand in funding, of which 7 billion has been drawn down. So we still got a strong pipeline. So thinking earlier about the growth opportunities, there's still a strong growth opportunity in that. I think Nedbank's very well positioned, leveraging our strength, but to make a sustainable difference in the country. Quickly going on to productivity, now going to get a little bit more boring because I'm talking about banking issues. I'm trying to make it simpler. We've got a lot of growth opportunity. Last year we put our corporate and investment bank together because we just found there's a lot of opportunities where we didn't collaborate, we didn't cross-sell properly. The growth opportunities very much in the rest of Africa. If you can look at what's happened in the investment banking space over the last few years, especially renewable energy, infrastructure, telecoms, strong growth outside of South Africa. But even in South Africa, the success in renewable energy that we've just shown, some of the infrastructure projects, is still giving us good growth potential in the investment banking space. And in the retail and business banking, you guys need to read this half year on half year because there's seasonality. We've been very conservative, especially in the unsecured lending market. We don't do payday loans. We don't do restructured loans. We've stayed away from a lot of the issues that were out there in the market. We're the only bank that have actually shrunk our book, but making sure that we do lending to people that can really afford it. That has had a negative impact on growth, but we are now sort of bottoming out. And what we're seeing is growth starting to pick up this first half in all our categories. Our vehicle finance business, which is more focused on the second-hand vehicle market in tough times. People move away from buying new vehicles. They buy second-hand vehicles. So our MFC brand is doing really well. And then through our home loans channel, I spoke a little bit earlier about our instant bond indicator. We said a lot of value gets destroyed when you go through originators, and we've developed, the only bank that have developed online channels. We launched a month ago an initiative called in the instant bond indicator. Within 3 hours, you can get an answer of whether you can afford your house or not and whether you'll be successful. That's compared to an industry turnaround time of about 2 days. We thought we were going to get 50 applications a day. We're getting 1,000. So, and that is good quality business, efficient through the right channels. So we are growing, but we're growing sensibly. We don't, in this environment, we don't want to put our consumers under stress, and we also don't want to get surprises down the line when interest rates start rising. Then just on the other two metrics, non-interest revenue, that's the type of fees you generate. You guys saw the strong growth in client numbers. That's been supporting very strong growth, historic non-interest revenue growth in the past. Obviously, we're coming off a low base compared to our peers, so we're gaining market share. Last year, we had a bit of a dip for two reasons. Firstly, we said we want to make sure that our prices, our bank fees are competitively priced. We cut our fees in retail relationship banking and in business banking, and we had 0% increases at the start of last year. We benchmark all our products. Nedbank is in the lower half of pricing. There's still a big perception issue that we need to overcome. There's still a lot of people that think we are expensive, and that's one of those were the initiative to cut fees. And then we also slowed down in personal loans, so that had an impact. And I think very pleasingly, we're back on the growth trajectory. And NRRs is a good revenue source. It doesn't consume a lot of capital, so when we get later to capital, you'll see. And then I think very importantly, in a tough macroeconomic environment, you need to focus on your cost line. We've integrated the back offices of our retail and business bank, integrated CIB. We're taking our core systems from 250 to 60 over time. We've already decommissioned 80. We've got a lot of initiatives with our parent Old Mutual on the go. How can we do things? How can we use our procurement power to reduce our cost base? So I think that's all trending in the right direction. If we look at risk management for a bank, very important that you've got a strong balance sheet. I'm not going to go into the technicalities, but your capital ratios need to be strong. We are at the midpoint of our target range. That line there is what the SARB requires as a minimum, so we well capitalized. In line with Basel III, we need to hold more sources of quick liquidity, and that line's going up. And then, in a NSFR world and a net stable funding ratio that's coming in 2019, you need to match your long-term lending with your long-term deposits. And we're making good progress and actually leading the industry in our long-term funding. 27.6% of all our funding is greater than 12 months. That puts us in a very good space from an environmental perspective as we head into tough times. We also lend, so as a bank, because you lend, there's a lot of risk. Things can go wrong. And I think what's pleasing is that all the actions we put in place have resulted in our defaulted advances. So people that have missed 3 payments, that's actually still going down, which has actually countered the industry because we've been very prudent. And coverage, which is how much of balance sheet impairments do you hold against that? Then also, we can also look at our impairment ratio, which is now the lowest in the industry. 2 more things that I'd like to focus on. We've got a well-diversified bank, mostly wholesale. So in this environment where consumers are likely to be under pressure, we are well-positioned, and growth opportunities in the rest of Africa and still in retail. So well-diversified. And then transformation, I think it's very important for every company to play their part in society. And Nedbank has been rated number 1 for a couple of years in that space. This is all underpinned by independent board and experienced leadership. Our board is independent. We do have Old Mutual on there, and they don't classify as being independent. So despite that, we had to work really hard to make sure we've got a lead independent director. We all comply with best practice. Very diversified board with skills, with a broad skills base that we've addressed over the last few years. So just lastly, return on capital, I think for banks, banks used to have high ROEs or returns on capital. I think because we have to hold more capital because the world's a tougher place and all the Basel regulations, that's had an impact on leverage. But important for us is that ROEs are still going up, and ROAs are going up, and ROEs are following suit. But we have to hold more capital. It just makes us a lot simpler. This is the last slide I'm going to show you. We always show this. We report back to our shareholders on how we perform. This is a slide from our interim presentation. Did we create value? Did our net asset value per share go up? What happened to are we generating return above our cost of equity and on the dividends? And I think that's a good story. It's tough out there, but But I think that underpins everything that we do. Thank you. We always get the question, we go on roadshows and we always get the question, do you guys coordinate up front? And we don't, it's just part of the culture. So it's difficult to find green ties though.
We'll keep an eye out. Do we have any questions for Alfred?
Yes.
Hello. Hello. It's Kenan from Coro Capital. Just first of all, congratulations on what you guys have done in the green space. It's been phenomenal from the sustainable point of view. But I just kind of have a question on that and more relative to what other companies have done out there. First of all, I mean, obviously the management in Exco is still motivated by ROEs and have certain shorter-term KPIs where these kinds of projects returns are sort of more on a longer-term basis. And so the motivation to do these projects is not always there from a shorter-term perspective. But having said that, the returns can sometimes be good are normally quite good on these projects anyways, and therefore there's a balance between what the returns are on each of these projects, and I would imagine that the returns have been pretty good because more money seems to keep flowing into these sustainable projects, and therefore they are still good. But so the first question is really, how much is driven, the motivation behind these projects driven because of the returns first, and then, oh, well, we're actually doing something good for the sustainable environmental later. Yeah. And if the returns weren't there, would these projects still be happening? Yeah. And what is the motivation driving that project if it does happen? And then secondly, what would you say to companies that haven't been as successful as you guys have been from that perspective? Because we've had interactions with many listed companies where we've taken certain projects to them with sort of 12, 11% returns ungeared, and they just kind of go, well, that doesn't meet my KPIs for the next 3 years, and we just get put off for these kinds of projects because it's all about returns. It's got nothing to do with sustainability.
Yeah. So I think firstly, I don't think the attraction is just the financial return. You know, in all these, if we take the renewable energy deals, for example, you had all the banks participating. It's what is the value and how do you look at the value, whether it's short or long term? You know, so unless in some of these deals you can do some of the advisory work, the lending's good returns, but it's, you know, like you said, it's a 10-year, so you need to have a longer term perspective on it. I think internally, you know, whilst it needs to meet certain hurdles, I think there's a lot of internal drive. There's a lot of the DNA in the organization that says this is the right thing to do. You know, it obviously doesn't make sense to do something that's sub-economical. You know, you need to think about, so how do I then add value to make it economical? You know, our executives always talk about a lot of the things we do today, whether it's the 10-year renewable energy deals, whether it's the infrastructure we're putting in to get our retail bank competitive, those benefits won't be there for this management team. Some of those will only be, you know, you only get the rewards 5-10 years down the track. Some of them will still be around. So I think there's part of the DNA bit in there that says how we make decisions and how we run these things is not just for the short term. You know, incentive schemes are structured over, you know, over a 3-year period, and we've had a lot of conversations, you know, I think with Coro as well as, you know, shouldn't we move that out to 5 years? And we also try to do it relative, not just ROE, but also relative share performance. So you try to have a balanced view of how people get incentivized. Suggestions for companies on how they need to do it, you know, I think it's not something overnight. I can remember 15 years ago when we've had a partnership with the WWF now for more than 20 years. And a lot of people would say, well, why are you doing this? Where's the financial benefit? And we said, firstly, we're doing it because it's right. Now there's a financial incentive to it because we had to do it. We had to get our own house in order. We have to make sure that we practice what we preach, that our own buildings, our own employee behaviors are right. And then it becomes easier when you've got investment banking skills to then advise and participate in some of these deals because it's in your culture. You can see things early on before somebody else. I guess get your own house in order before, and take small steps at a time. We weren't carbon neutral from the start. It was part of the journey that we were on.
Thank you. Hi, thank you. Morning. Well, maybe some few kudos to you. Either because I've changed my phone number. I no longer get those messages.
Before you ask the question, just introduce yourself and where you're from,
thank
what
you.
institution you represent. Thanks.
All right, thanks. The name is Zithulele Qindi. I represent the Community Growth Fund, the first SRI fund in the country. Let's leave it there. We can have a conversation during tea. But what I was raising is that, kudos to you, is that I no longer get those SMSs which were bombarding me that I can get 100,000 rand loan and so on, which I felt was flouting legislation and the spirit. But I mean, I no longer get them. So I'm saying kudos to you. Just one point. In the clip, I thought I heard that you are in 6 buildings that are green, but your slide was giving me 4. So just...
We've subsequently, the
okay.
1 point was, the 4 was
fine.
last year, and we've done
fine.
another 2.
It's okay. However, for a bank, I would be interested to know your views. I thought I would see it. Being in the lending space, equator principles, I didn't hear any comment or reference to it. I didn't hear any comment or reference to Basel III. So I just would want to know what's Nedbank's.
Yeah, so we've implemented the equator principles probably 10 years ago. And, we get a lot of people saying, you shouldn't be funding Eskom. There's a big tension between, keeping the lights on and, and having energy security versus not doing any type of mining, coal, things that aren't right. So we're trying through the equator principles, through our advocacy, when we do these type of projects, make sure that they adhere to sustainable principles. So, before we go into a contract and we lend the money, we make sure that our clients, that there are offset projects or that there are mitigants in place to, when we go. So we definitely comply and subscribe to the equator principles. Basel III, everything I spoke to you about, the LCR, the Basel, the capital ratios, all of that fits in the Basel III space. And we are compliant on the capital ratios, very strong capital ratios. The LCR that came into effect this year, we are compliant. It sort of ramps up to 2019. You saw a ratio of 73%. And that's above the 60% compliance. And the only outstanding bit is the NSFR, which is you have to fund your long-term assets with long-term. And that South Africa's got a structural issue because we don't have enough retail savings, but we've got a developed mortgage market. So a lot of people got houses that are funded over 20 years, but we don't have a big retail savings market that can match that. So we're looking for the SARB to look at what other tools they can provide the banks to make sure we comply. As a country, we don't have an issue because we've got a closed funding system, so money can't. It's not like a Greece. If something goes wrong, somebody just pulls out all their money. South Africa's got a closed funding system, so we've seen it in banking collapses, Sambo. We've even seen it with Able. As soon as something happens, the money just finds itself away, either through the central bank or the asset managers back into the banks. Okay.
So I'm afraid that's all the time we have for questions. Do we have? Okay, last question. Quick one.
Thank you. Nice presentation. I'm Linda Maiba from Telkom. Outlined that as you doing very well on your transformation agenda. I just want to know that it's based on the revised legislation. how sustainable are you going to be retaining that number one that you've outlined in the slide in relation to your transformation agenda?
Yeah, so I think as we transition to the new codes, there's new hurdles. I think in the current proposal it will definitely drop. There's still a lot of water to flow under the bridge around once empowered, always empowered. But I guess that then applies to all the banks equally. So we may not have a level 2. We're still waiting for clarity on that. But, safe to say that it will remain our focus. We're not doing it for the scorecard. The scorecard is an outcome of what we do. And you can see on all the bits where we take all of these things serious. Our Black Economic Empowerment, our partnership scheme matured the start of the year, and we unlocked 8 billion of value for our clients. Now, you could argue there needs to be another scheme, but the value has been developed across a broad base of stakeholders.
Thank you.